Let's start there, David, with the Fed. I mean, I think our central bankers have made it clear, David, they're in no hurry to cut. But what are you expecting the Fed to say and do this week?
As far as Fed meetings go, I suspect this one's going to be pretty boring, relatively uneventful. I expect the commentary from Chair Powell, largely going to be unchanged from the commentary he's made in the past. So I think likely he'll just mention that they still want to see additional data to get the confidence that inflation's on that steady downward path. I think they'll acknowledge that the economy is slowing, but not slowing to the point that it's necessarily concerning the Fed at this point. So I don't think we're going to get any kind of commentary surrounding, when the Fed will be thinking about the Fed starting to cut the federal funds rate. I think it's really going to be the July meeting that's going to be the one that's going to be a lot more important. We do think the Fed is going to start cutting rates at September. So if they do start cutting rates at September, I think they're going to want to give that indication to the market, at the July meeting. So I think that's when they'll start providing some guidance, maybe remarking that, the Fed has then at that point the higher confidence that inflation's on that downward path, and maybe also mentioning and highlighting that restrictive monetary policy has been slowing economic growth.
What about, we're also, of course, getting CPI on Wednesday morning. And how confident are you that we're going to continue to see sort of deceleration in inflation that will allow the Fed to start cutting as soon as September?
Mm-hmm. Yeah, our U.S. economics team is still very confident that they are expecting moderating inflation, in the second half of the year. They look at a lot of different, real-time indicators like shelter and rent costs. So those have been coming down for a while. They expect those to start filtering through, the next couple of months. So really, it's just that combination of inflation starting to moderate, the slowing economic growth, that'll give the Fed the room that it needs to cut. We think that they cut at September, probably skip at the next meeting, and then cut one more time at December. So our base case Fed funds rate comes down at the end of the year to that 4.75% to 5% level. But we don't think the Fed will be done there. We forecast the Fed will continue to cut through much of 2025. And in fact, by the end of 2025, our U.S. economics team expects the Fed to get down to 3 to 3.25%.
Let's say, David, your base case doesn't come to pass. The Fed doesn't cut this year. Would that change your view, David, of the U.S. stock market? Does the market need those cuts to move higher?
We do think that they're going to need those cuts to move higher. So right now, when we look at real GDP, our base case is no recession. We're looking for that soft landing, albeit a slowing rate of growth for the next couple of quarters. But that's also predicated on our assumption that we do think the Fed, starts to cut. So if they don't cut, that could put that base case, into jeopardy, and we could slip into a recession, early next year, if that doesn't happen.
David, I want to switch gears for a sec because we've been talking a lot about technology today. We're not done. We're never done when it comes to this stuff. And we recently saw a chart came to us from Torsten Slok of Apollo, which happens to be the parent company of Yahoo Finance. But he's not alone in the observation, looking again at the concentration of large cap tech in the S&P 500. The top 10 stocks overall in the S&P now make up 35% of that index. That's a record. What do we make of that? What do we do with that information, if anything?
Well, like anything else, it really always comes down to the fundamentals of the individual stocks. Now, specifically within technology, the past couple of quarters, I've really kind of been breaking technology into three different buckets, in my own mind. So we have, the AI and the cloud. Again, that's the area that has the highest growth, the best long-term secular trends. But generally speaking, those stocks are pretty fully valued, if not getting to be overvalued at this point. NVIDIA, we still see another 4 to 6 more quarters where demand is going to well outstrip supply. But even thinking about that, it's a 3-star rated stock trading relatively close to our fair value. Then I look more at the traditional tech names. Again, that's where we're starting to see, some of the better undervalued opportunities. My concern is that it might be a couple more quarters, before some of those names, start to work, see some value in the semiconductor space, the software and the service space. I still like cybersecurity. Fortinet and Palo Alto are 2 stocks that we rate, 4 stars that we think are attractive. And then lastly, in tech, there's the legacy names, the names that we think the best days are behind them. 2-star rated IBM, 2-star rated Hewlett Packard would be the 2 that I would shy away from.
Thanks, David. Good to see you.
Oh, thank you.